Hi, everyone, and welcome to fluidTalk. I'm Chris Cochrane, founder of Fluid, and your host today. When we created fluidTalk, our goal was to bring together the best minds in tax, law, and technology, people who live these challenges every day. And that's why I'm thrilled to have Wentzel here with us today. They bring deep legal expertise to the judgment side of this equation, while Fluid provides the AI-driven data and communication platform that makes the judgments defensible. Judgment calls need context, and context needs data, and that's the bridge that we at Fluid built. With me today is Cor. Cor is a partner in the Wentzel tax practice, an international tax specialist with more than 15 years experience advising across, well, I think it's actually closer to 20 years now, Cor, advising across industries from finance and energy to e-commerce and private equity. Divan is a senior tax manager who brings deep experience in corporate and international tax advisory, mergers and acquisition structuring, and reorganizations. And before joining Wentzel, he served as a group director at Naspers in process. We're thrilled to have both of them here to unpack the realities of controlled foreign company compliance in a world that's changed dramatically since the rules were written. Please just note that the chat is open for questions. So if you do have any questions as we're working through the content, please pop them in. We will have 2 slots for Q&A. So if you can pop in those questions, we'll get to the ones we can today. And those that we can't, we'll do our best to circle back to you after the session. So with that, let me just get my screen shared here. Divan, Cor, thanks for joining us today. I think let's start with the big picture. 2 decades of the same CFC rules, but we're now living in an entirely different world. When Section 9D and the FBE definition were written, business meant people, offices, paper trails, very physical evidence for establishments. Now everything's digital. Data lives in systems, not filing cabinets. So the law hasn't changed, but has the world outgrown the way we prove substance? We look at the shift. We used to have oil, automotive, retail businesses. Now it's platforms, data, algorithms. So Divan, you've seen this firsthand. What's making FBE compliance harder today?
Thanks, Chris. It's like you say on the screen. The CFC rules were written in 2001 when the world looked a bit different in terms of business models. If we look at the slide that you've got up, we see that the predominant businesses were making products, extracting resources from the earth. It was quite obvious where the primary operations were. Move forward about more than 2 decades. Those business models are, of course, still extremely relevant, but we see new business models. We see functions dispersed geographically. We see users of platforms in one jurisdiction, servers in another, administration somewhere else. So the challenge that we face is that the FBE exemption remains a key exemption in Section 9D, but the lens through which we have to look at its requirements, which are still pretty tied to physical substance, has changed a bit. And we need to think about new concepts like hybrid working and people working from home. So our judgments become a little bit different.
Thanks for that, Divan. Cor, any input there?
Yeah, exactly that, colleagues. The world has moved on, but the coding of the words haven't moved on a lot. The tax law is still written with a fixed bricks and mortar type business in mind, yet for all of us, the way of operation has changed. So these days, the judgment level of qualifying for an FBE has elevated a lot more. In the past, you would have simply looked at the geography. Yes, I've got employers, that's the end of the story. Not much of a discussion after that. But these days, it's more murky, it's blurry, and hence the judgments.
Thanks for that, Cor. So I think let's look at one of these complex structures, an investment holding company as an example, right? To see how these principles can hold up in practice. So let's ground this in a real world example. Divan, we've got a US investment holding company here, sits above 3 operating entities in manufacturing, distribution, and shared services. This is quite a common structure that we see in many multinationals. The top entity looks passive, but it does drive group strategy. Can you maybe walk us through what's actually happening inside the structure day to day?
Sure. As you say, Chris, this is quite a typical setup. So what we have on the slide is subsidiary A, which renders group shared services, so HR functions, finance functions, procurement, and so forth, to some of the entities within this US grouping. Subsidiary B is the group's manufacturer, so it makes the product that this particular group sells. And in this example, subsidiary B sells all of its output to another group company, subsidiary C, who's the group's external distributor. So sub C deals with external customers. Layered on top of that is investment holding company. So investment holding company makes capital allocation and strategic decisions with respect to this US grouping, but it does not have its own staff. It utilizes the resources of subsidiary A, so it uses the staff of subsidiary A. And when we look at its income streams, it earns items such as dividends from the subsidiaries, some management fees potentially, and now and then perhaps a capital gain when it disposes of an investment. So as you say, the first impression that one might have looking at the investment holding company is that its activities, certainly compared to subsidiaries A, B, and C, feel a little bit more passive.
Yeah, and Divan, exactly. That's although this is a pretty common structure we see in modern times, and often operated as an economic single unit, it does pose difficulties and when trying to determine does one or all of these entities, one or more, qualify for the FBE exemption, particularly now in this instance, the intermediary, the investment holding company, and that's where the lines get blurred.
100%, Cor. Yeah. So, Divan, maybe you can just talk us through a bit of how this investment holding company can actually be justified as an FBE.
Yeah, sure, Chris. So the requirements, as we said when we started, the requirements are still pretty much the same in terms of the FBE definition. It's the application that can require a bit of judgment. So in essence, the requirements remain that the investment holding company needs to conduct a business, and we'll touch on some of those judgments in a bit, but then there's no getting around the substance requirements. So investment holding company still needs to have the required fixed place of business where it operates that's available to it in order to meet the FBE definition. So the key requirements would be that it is conducting a business and that either it has itself got that substance, so it has its own offices, staff, etc., or it shares those resources with another group CFC. So there's simply no getting around it, but we potentially need to think about it a bit differently.
Yeah, legal and from a legal point, Divan, just to add to that, the key question first we start off asking: does the investment holding company conduct a business? And here we got to be clear in our mind. There's a body of case law on what this means. It's not the place to take a deep dive on that now, but it shouldn't be confused with the more narrow activity of that of trading, buying and selling things. That's not the only route to meeting the FBE test, because the question is rather, are you conducting a business, not necessarily whether you are a trader of sort. That to the side, importantly, the CFC rules in the FBE definition does allow us to, in certain instances, take recognition of group company substance in order to determine whether the investment holding company itself can meet the test. And as we all are aware, the sagas of the coronation case ultimately being settled in recent times, it really is not asking what are all the possible activities that a company could be doing, but rather asking and to clearly identify, based on the facts of that particular entity, what is its primary operations, and then deducting from that whether or not sufficient people and physical substance is met. So really much not a formalistic answer, but a judgment-based answer.
So Cor, if judgment, not geography, drives the test, right? Where is the line? At what point does shared or remote substance stop being enough to support an FBE claim?
So in the context of the legal framework, we got to say to ourselves, we identify the primary operations, we've got that, and then we got to say, if those activities are performed by group companies in the same jurisdiction from the required physical presence, we can take that into account. Easier to explain by way of an example of what's not working is if, in this instance, subsidiary A, the staffing function, was located in Europe, then we can't claim an FBE in the USA for the investment holding company. That's just an example.
Thanks, Cor. So I think the reality is that in order to make these judgment calls, you've got to have data and information at your fingerprints, at your fingertips. This isn't a gut feel. It's a real judgment call and with insight that is required to make these calls. From our perspective, the Fluid platform lets teams pull all this operational data together into a central data lake, and then be able to access it very easily and focus more on making the judgment calls and making the right call than chasing your tail, trying to gather all the data together that's required. So let's jump into our next topic. We're going to be, but before we do that, we have opened up the chat for Q&A. Are there any questions out there? Perhaps to our audience, in your experience, where do you find the toughest judgment calls lie? Let us know. Let's see. So we've got a question here. From a practical standpoint, how far can you lean on shared substance and shared services within the same jurisdiction?
Yeah, Chris, I think we briefly touched on the principle is that within the confines of a group company, you can do so. The practical challenge for the person who has to complete the CFC return in South Africa is to say, well, my foreign subsidiaries tell me that we're all working together and we're sharing resources. How do I prove that? Because I have to make a positive statement in my return here, and that's where the evidence of intergroup services, salaries, KPIs, all of that type of data. Each case may have its own nuances, but it's got to be available to you, either firstly for the tax manager to make the call around FBE, secondly to prove it to the statutory auditors when it's checked, and ultimately thirdly to SARS if it's ever queried.
So, Cor, yeah, I think we got another follow-up question that actually fits into that quite nicely. Stefan's asked you, do you need an SLA between group companies when relying on shared substance?
Yeah, and often those don't exist because the group operates as an economic whole, and there's often also part of some or other tax grouping. So purely from an economic or a legal and a tax perspective in that jurisdiction, there's no need for it. We know that SARS would like to see such agreements. My own view is they are not essential, but then what do you use as a replacement for proving that those arrangements are in fact taking place. So an SLA is a convenient and an obvious way of proving that, but there could be other ways, KPIs, general group forums where these things are discussed and documented. So first prize, always the SLA, but not definitive if there is not one available.
Thank you, Cor. We've got another questions popped in here from Francois. Sometimes the IHC or an FBE is invested in an SA opco. Does that cause tax traps?
Divan?
So let me just think this through. So sometimes our CFC is invested in SA opco. Yes,
Yeah, one that jumps to mind is the loop structure concern, you know,
yeah,
or inefficiency is one example.
Yeah. So although now technically allowed, we have got new tax rules around this that do result in any dividends through that structure being effectively subjected to tax in the ultimate resident's hands through the CFC rules. And also it is relatively difficult to get new structures such as this approved. So definitely some tax, not necessarily traps, but definitely some tax considerations to think through where these are your facts.
Yeah.
Perfect. Thanks, guys. Well, thank you for those questions to everyone. We need to move on. So please do pop any more questions into the chat. We will have another Q&A session coming up now. And as I say, if we don't get to them, we will circle back to you after the session. Divan, so we've established our IHC likely qualifies as an FBE. Let's move into the next challenge. It's financial instrument income, right? This is where the CFC rules get tough. So passive income like interest, dividends, forex and capital gains, these are the very things that CFC rules aim to capture. Maybe unpack why those income streams can cause so much difficulty in practice.
Sure, Chris. Like you say, originally, these were the types of income that the CFC rules were aimed at, so-called passive or mobile income. And that's still the case today. So what we find is that outside of typical exemptions like the high tax exemption and the participation exemption, for instance, where you dispose of shares, the relief and exemptions that are available with respect to financial instrument income is quite narrow and often very conditional. We will see in a few moments in an example also how one needs to think quite carefully about these exemptions to be sure that they are actually available. So if we assume that our investment holding company does have a foreign business establishment, there are two potential exemptions that are available to it. The first is the so-called 5% FBE de minimis exemption, which is a sort of calculated shield that exempts foreign exchange and financial instrument income to a certain calculated extent. And then we've got another exemption, which is called the ordinary course of business exemption, which is a very helpful exemption because what it exempts is foreign exchange gains that arise with respect to items in the ordinary course of your business. So let's say the CFC's got a foreign bank account, a foreign debtor, or a foreign creditor. If those form part of its ordinary business, then those foreign exchange gains are exempt. That's why it's sometimes called the working capital exemption, but it is a bit broader than that. However, that specific exemption falls away in the event that that controlled foreign company is deemed to be either a treasury operation or a captive insurer. And we'll spend a bit more time on that in the following example.
Yeah, so that's an important nuance, Divan, is deeming provisions. You know, if one looks at at Section 9D and you look at the original and the policy document written around that, you see that often the examples the legislator have in mind is very simplistic and assuming that an entity is only conducting one activity, where the reality is entities may be conducting multiple activities. So the nuance around the deeming provision could result in an outcome that is completely unexpected and often removed from the commercial reality. So really something to look out for, and something that the FB exemption really hinges on in this context.
Thanks, Cor. So I guess the word deemed is that's a key concept here, right? There's a scenario where I could have a legitimate manufacturing business going on in a foreign company, established in a foreign company, and this business, according to the letter of the law, can be deemed to be a captive insurer.
Or a treasury
Can you
company.
yeah. So I mean, Divan, can you maybe kind of talk us through the scenario, how that happens, and then Cor, you can talk to us through how to handle this in practice.
Chris, it seems when you explain it like that, and when we assume that our subsidiary B, for example, manufactures washing machines, which it sells to subsidiary C, it seems fairly logical that it would be a deemed captive insurer, right? But let's have a look of whether that's technically possible. So it's going to get a little bit theoretical, but please bear with me. So if we look at the relevant deeming provision in Section 9D, it determines that a controlled foreign company, which is subsidiary B in our case, will be deemed to be a captive insurer if any one of the following three conditions are met. So the first one states that less of its principal trading activities, so the manufacturing of washing machines, are conducted in the country where its FBE is located, the US, than any other single country. I think we're pretty comfortable that that's not the case. Subsidiary B manufactures in the US. That's where its FBE is. So that should be okay. The second requirement is that those principal trading activities, and unfortunately this is phrased in the negative, so it's sometimes a little bit difficult to catch the true meaning, but those principal trading activities, so making washing machines, do not involve the regular transaction of insurance business with clients that are not connected persons. So on a strict reading of this, the principal trading activities of manufacturing washing machines do not involve the regular transacting of insurance business. And we also know that subsidiary B transacts exclusively pretty much with connected persons, being subsidiary C, the group distributor. So the second requirement should be met. And if we look at the third one, less than 50% of the amounts attributable to the effectively sale of washing machines are derived from the principal trading activities. So subsidiary B would derive fairly close to 90 or 100% from its income, from its principal trading activities, and it would be from a connected person. So whilst it does not seem to be an intuitive answer, on the face of things, it looks like subsidiary B is a captive insurer, which means it would not have access to the ordinary course of business Forex exemption.
Thanks for that, Divan.
Yeah,
So, I mean,
Divan.
Cor, sorry to jump in, Cor. I mean, it seems like this reductionist approach leads to almost like an absurd outcome, that our washing machine manufacturer is a deemed insurer. Maybe you can just talk us about how you handle that, Cor.
Yeah, I think you know that type of thinking equally applies, of course, to the deemed treasury operation, where in an extreme example, a bank can be deemed to be a captive insurer, and a captive insurer can be deemed to be a treasury operation. So clearly something's wrong. We can't follow those rules, because it would undo a big component of the mechanics and the legislation worded in 90. So that brings us into the world of statutory interpretation, and there's a whole body of knowledge around that. But in its most simplest of forms, we start with looking at what the text says, and to the extent that there's an ambiguity, more than one meaning. I'm again oversimplifying, but only in those circumstances do we default to what is a sensible business-like interpretation of the provision? What could this really mean? And in our minds, those provisions interpreted properly is rather aimed at elevating existing activities within a business to its principle, as opposed to deeming something that is of a very different nature to be that. So by way of example, in this subsidiary B washing machine manufacturing business, we don't think it's the intention and that it's a sensible interpretation to deem that entity to be a captive insurer or a treasury operation. If, however, subsidiary B's main operation is that of washing machine manufacturing, but it also conducts clearly a group treasury function that is of not principal importance, but secondary importance, we think that in those instances, that activity can be elevated to be deemed the principal activity of the business, which then has got certain consequences for the CFC rules. Now, different practitioners, different people can see it and interpret it differently, but I think the point is, if we can agree that there is an absurdity, it can't be that we can blanketly apply that legislation, then we have to follow the rules of interpretation, and that gets us to an outcome that is much more businesslike. Of course, it leaves open still the interpretations around things like, well, what is a treasury operation? We can't point to a specific definition. So you, as the person responsible for making these calls, will have to say, well, on what basis do I believe that this entity does or does not conduct a treasury operation? I don't think the granting of intercompany loans per se is enough to be seen as a treasury operation. But what more do you need to do in order for it to be a treasury operation? So you need to look at your picture, and on those facts say, well, on this basis it is, or on this basis there is not treasury or insurance functions, and then look to the deeming provisions to see if they apply. But a minefield of interpretation.
Thanks for that, Cor. So, Divan, from a practical perspective, how would a tax manager go about, I mean, kind of identifying these potential issues, and what can you do proactively to kind of avoid being caught in this trap? I mean, you don't want to be going and applying ordinary income exemptions, and then SARS comes to you and says, "Oh no, wait, you're a deemed treasury operation." And so, what kind of practical steps would you recommend people take?
Chris, I think that the trick comes in with looking at a standard CFC process. A lot of this is driven by the data that is presented to the tax manager that's responsible for the process. So there would be a submission of a form or a list of answered questions. There would be some financial data. And based on that, one would typically draw the relevant conclusion. I think what gets very important is that from an evidence perspective, should you be queried by a tax authority and so forth, those confirmations and sort of softer forms of evidence might not necessarily do the trick in those situations. So I think what is quite important is that during your compliance process, where these critical judgments happen and where they may result in materially different outcomes, that at that point you gather the required evidence to support that judgment. Because what happens often after the fact, a year after the fact, or 2 years after the fact, a query might arise that evidence was simply not gathered at the level of sort of rigor that it needed to be gathered, and people have moved on into different
Or it's sitting
roles.
on someone's hard drive, right?
Or it's sitting on someone's
or it's
hard
lost somewhere on SharePoint.
Yes, exactly. And that's not a situation you want to be in, because let's face it, the implications of these judgments can often have very severe financial implications.
Yeah, I hear you. Thanks for that, Divan. So I think that's a case where the Fluid platform really comes in and not only gathers the information but stores it and makes it really easily available, and has a full audit trail for these kinds of scenarios where you need to get back to the information and you need the information at your fingertips. So we're into our next Q&A. Are there any questions out there? Have you come across situations where a company's real-world operations didn't match how the CFC rules treated them in your operations? Let's see if there are any questions on the chat. So, Divan, we've got a question here. How do you defend normal funding flows that appear as treasury income against tax rules that could reclassify them under captive insurer or treasury deeming provisions?
Chris, I think it goes back to the point that Paul made earlier. I think one starts off, as we did with our subsidiary B, and one makes a determination of, when we look at this entity, is it in fact conducting some level of treasury operations? I think where that is clearly not the case whatsoever, I think one would make the argument along the lines as Paul set out. Sort of a business-like interpretation where the rules would force one into that bucket, so to speak. I think where there are actual treasury operations taking place within that entity, I think then the rules would likely result in the proper application of what was intended.
And Divan, to supplement, to add to what you've said there, keep in mind, colleagues, that the deeming provision around treasury operation captive insurer is not applicable to the 5% de minimis rule. So you may sit in a world where, for purposes of the ordinary course of business foreign exchange exemption, the small treasury operation in the entity is elevated to principal activity, and that exemption no longer becomes available to you, the ordinary course. But when you default then, as a last stop to the 5% de minimis, there you follow ordinary meaning and ordinary principles, and hence it will only be the treasury component of it that won't qualify for the de minimis. But the balance of the business it could very much still qualify, because it's not primarily, or it's not attributable then to a treasury operation. Gets highly technical, but not only is there a deeming provision, but the deeming provision doesn't count for all references to the particular term. So just interesting.
Thanks, Cole. So, to move on, so far we've looked at how interpretation affects the FBE test and financial instrument income, but there is another minefield. Transactions between CFCs, right? They often seem harmless because the income and expense are eliminated in consolidation, but that's exactly where the hidden traps sit, right? Divan, can you perhaps give us a sense of why these can be so misleading?
Yes, there can be traps, Chris. I think as you mentioned, items like interest, royalties, rentals, foreign exchange differences, and so on between group CFCs are disregarded and exempt. So in this scenario, if subsidiary A charges interest to subsidiary B, subsidiary A would disregard its interest income, and subsidiary B would not be allowed a deduction when looking at its net income. So we achieve some neutrality on that basis. However, certain traps can arise where one of the entities in the picture has an external leg, whether that be external interest income, let's say from a bank with a back-to-back loan through the group, a derivative instrument, or as we will unpack in our next example, royalty income.
100%, Divan. So I think let's jump into the IP licensing portion here and where that can actually break the FBE chain. So we've got an example here where our IP owner is sitting in subsidiary A, and we've got subsidiary B as a distributor or licensor. Perhaps you can just talk us through the traps in this scenario.
Sure. So what we have here is subsidiary A owns intellectual property. It charges a royalty fee to subsidiary B, who is the group's external licensor of that intellectual property. So Step one, our inter-CFC leg of that royalty is disregarded. So subsidiary A will not be taxed on its inter-CFC royalty income. Subsidiary B will also not get a deduction of the royalty that it pays to subsidiary A. But here comes the challenge. Subsidiary B earns external royalty income from a third party with respect to intellectual property owned by subsidiary A. Now, most of us would know that intellectual property related income, such as royalties, is also a target of the FBE rules, being quite a passive form of income. So it's targeted unless it's not passive. So it's carved out from the FBE exemption unless the relevant intellectual property is directly and actively upgraded or developed by that controlled foreign company. So as we can see in this current example, subsidiary B is earning the external royalty income. Step one is FBE exemption does not apply unless you actively develop that intellectual property. Now it's owned by subsidiary B. So on our facts, subsidiary B likely does not do so, and it would be taxed on that external royalty income. But because of the inter-CFC rule that we discussed in the first instance, it's got no deduction to claim against that income. So effectively, subsidiary B would be taxed on the gross royalty income. Now, there are some options that one can consider in these types of constructs. So for example, of course, if subsidiary A directly transacted with the third party, it's likely, if that IP was actively developed, that it would benefit from the FBE exemption. Also, if subsidiary B, rather than being a licensor of the intellectual property, if it was an agent of subsidiary A and rather earned a commission, we also would have possibly been able to more easily fit that commission income of subsidiary B into the FBE exemption.
Thanks for that, Divan. So, Cor, I mean, I guess the key here is that the tax treatment needs to follow the legal form, not necessarily the underlying economics. And so I guess we really need to have our house in order when it comes to the contracts that we have in place between these entities.
100%. Ultimately, our CFC rules need to be applied to the facts, and in this instance, the fact would be created by the foreign legal relationships. And although economically there will be little difference between subsidiary B earning a small margin on back-to-back licensing versus earning an equivalent or a similar amount by way of a commission, economically that's not much different. The legal form clearly can here give us two very different CFC outcomes, and often is not on the radar of the foreign business because they just want to do business. They just see what's the easiest for our customers, yet our rules are still pretty mechanical, and as such, you can get a different answer for something that is really economically pretty similar.
Yeah, I guess this is something you got to be quite careful of and keep an eye on, because businesses change and they evolve, and you need to make sure that your contracting keeps up with it. Otherwise, you could get into a bit of a pickle with the CFC legislation. Divan, this is another scenario, slightly different, but also has some pitfalls.
That's right, Chris. And I think just to tack on to the previous point, I think these structural traps, if we can call them that, often happen quite inadvertently. Groups go about their business. There are various commercial reasons for structuring things in a certain way. And unfortunately, through a combination of CFC exemptions and income streams that are not exempt, one could get to a inefficient answer. So if we look at the current example, it's slightly different, but this is quite a prevalent fact pattern. So it relates to the concept of IP development. So in the previous example, we said that income from intellectual property, such as royalties, are typically carved out from the FBE exemption unless that controlled foreign company directly and actively develops and upgrades that intellectual property. So it needs to be an active asset in order to claim the FBE exemption. Now, what we often see is that there are certain hubs in the world where IP development, particularly software, where those skills are located. We often see this happening in territories like India, Spain, and so forth. So what we may find is that a subsidiary in a particular territory might make use of another group company to develop the IP on its behalf. So in our current example, we've got subsidiary A, who's the owner of the intellectual property and earning that external royalty income. However, the development of that intellectual property has been outsourced to subsidiary B. So if we look at the wording in Section 9B, it uses the word directly and regularly develops, upgrades the intellectual property. So the question in this construct is, if we outsource that IP development, does this fail the test?
Exactly, Divan. The law recognizes the concept of agency, and particularly, more specifically, the intellectual property law. There is an understood meaning of what the development means. And simply put, is intellectual property development in the software context, is it the physical act of coding, or is it the person who conceptualizes and remains in control and gives somebody an instruction to, please code the following? And I think there's persuasive arguments to be made to say, well, if subsidiary A remains in control, is responsible, and in fact does conceptualize and gives detailed execution instructions to a third party or a subsidiary to merely perform the execution activity of the development, you will ascribe the development function to subsidiary A and not to the third party, because that's simply executional. But it's a question of degree, because if you can't evidence that subsidiary A through, for example, weekly instructions, reports, development notes, etc., if you don't have those, then the presumption will be that the third party or this other subsidiary did all the development work. So it's a question of, one, understanding what does development in this context mean, actively develop, and secondly, then to be able to prove it.
So I think, so the key thing is, I would say is this is a case where you've got to be kind of on top of your game and aware and make any CFC operations aware of the impact that the Section 9D laws could have on their operations, having a South African parent. So thanks for that, Cor and Divan. So just to jump into on the how do we handle this and get the data together, be able to defend these positions? I mean, we've got quite technical and theoretical into a lot of the deep dark corners of Section 9D. Divan, you'll remember, I mean, from 2 years ago when we were still working together, how a lot of the work was still quite manual, even back then. We were collecting annual financial statements and trial balances. We had to maintain mapping tables and do manual reviews of the annual financial statements. I mean, I was demonstrating to you the other day how we've actually automated all the trial balance mapping and even extraction of data from annual financial statement documents and be able to reconcile those. How do you see that making a difference in the operations of multinational enterprises who have to report on these on their CFCs?
Yeah, Chris, I think the first thing that jumps to mind is probably a time saving. I think with a very manual process, it's a lot of information gathering, it's a lot of emails, it's a lot of follow-up, investigation, meetings, etc. So if all of that is structured and formalized and automated, I can imagine that that's a big time save. But then I think also we've we've spoken quite a bit about having the evidence to support the judgments that you make from a Section 9D perspective. So facilitating that would also be very valuable.
Thanks for that, Divan. I mean, that's exactly what Fluid's global tax platform is built for. It's allowing tax teams to be able to easily gather this data. And we want to be able to relieve the burden of tax professionals being data gatherers and having to chase people to send through information and then having to compile it into a single kind of a record for analysis. So on that, we'd like to conduct an audience poll to get some of your insights into when it comes to CFC analysis and your reporting for Section 9D, which part of the process keeps you up at night? So have a look in the chat. We've put a poll there. If you can just let us know out of these 5, if you can rank them from 1 to 5 and just let us know what it is. What are the biggest challenges that you experience? And let's so let's give a minute for people to respond to the poll, and then we can take it from there. Divan, so I mean, while people are responding, are there any kind of points that you think we've you want to jump back on, or anything we've missed out?
Chris, I think we've tried to put together a couple of interesting and nuanced examples. I think that the key takeaway is that Section 9D is highly complex, and there's a need for new judgments because of the evolution basically of business models. But at the core of it, we are dealing with the same rules that we've now had for a long time. And I think when one does make a complex judgment, I think the key takeaway from my side is at that to gather the required evidence at that point in time that supports that judgment, so as not to run into trouble later.
Fantastic. Good. Well, thank you for the responses. We've got a few still coming in. There we go. What are we seeing here? So consolidating scattered compliance data across systems seems to be one of the highest. Interpreting financial instruments, income exceptions. Yeah, so it definitely seems like one of the biggest pain points here. I don't know if you can see it on your screens, is consolidating scattered compliance data across systems. So yeah, we see that a lot in our customer base. I think it's the life of a tax manager, right? You not only need financial information, you need HR information, you need legal information, and trying to get that all together into one place can be very onerous and time consuming. So we've covered a lot today, from the evolution of business models to judgment calls around FBEs, financial instruments, IP. When expertise and technology align, CFC compliance stops being reactive. It starts to become proactive, right? Something that you can actually deal with confidence and apply your mind to, rather than having a kind of a reactive reporting at the end of each financial year. Cor, perhaps a quick closing from your side, some of the key takeaways around what we've discussed today.
Yeah, Chris, in summary, we sit with old rules in a very new world. We haven't seen, for many a year, there's not been a deep dive by the Revenue Authority into this domain. That has changed, rightly so. But it also then leaves the multinational in a position where not only do they have to make numerous interpretive and judgment calls, but they have to convince a number of stakeholders of their basis and rationality thereof. So for me, the more help you can get around routine data processing, so as to be able to spend time on the real judgment calls, which dictate what that data ultimately will mean, is where the modern CFC world is.
Thanks for that, Cor. So we're going to pop one more poll up before we wrap up the session. We'll have two options. One for let's chat further. So if you'd like us to get in touch and chat further about perhaps some assistance, either on your technology and efficiencies, or with insight and advice from the Weber Wentzel team, please select that option. Or you can select I'll think about it. That will allow you to save the replay and resources to visit later. But there was a question that came through about will you be able to download? Yes, you will be able to download it and access resources. And we will also share some links with you for that after the session. So from my side and on behalf of Cor and Divan, I'd just like to say thank you very much to you, the audience, for being with us today. We look forward to episode 2, where we'll be covering how to build an advisor-ready CFC compliance process in a bit more detail. So taking it more from the theory into practical process and execution. And I'd like to extend my thanks to Cor and Divan. Thank you so much for making yourselves available and sharing your insights. It's been really good spending this time with you and preparing for this. And we look forward to the next one.
Thank you all.
Thanks, Chris. Thanks, everyone.
Have a fantastic day, everyone. Cheers.